If you guys have been strategy hopping, trying to find a brand new way to read price action, this is definitely the video for you. I will teach you guys a brand new model that will teach you how to read price action through the wicks of a candle. So please watch to the end and I will show you guys every single tool that I use, every setting inside of those tools. And hopefully by the end of this video, you guys can find a brand new way to read price action and make some profit. Right in front of us, we have a blank chart canvas. Before we get into this video, I need to say that every single indicator that you guys will be seeing in this video will be posted in our Discord. So please go there if you guys want to add this to your charts. So the first indicator that we're going to be looking at is going to be the MCR indicator, and it will highlight pretty much the entirety of this model. So it's going to mark out everything that you need to know so that you can trade freely without worrying where everything is. The first things that we're going to see from this indicator is that we have MCR ranges. We have around 6 MCR ranges per day. And these are going to be the 1800. We're going to have the coil. We're going to have the London, the secret, the New York AM, and then the New York PM. So it's very close to the Asian session range indicator that you guys have probably used when you started trading ICT or any sort of sessions indicator. So this one, we just split up our day into 6 profiles, and these 6 profiles give us little tiny ranges. Most of these are going to be 22 minutes instead of this 1800, which is going to be around 1 hour. All the times will be posted right here. So let's get in this. The first things that we need to identify is what price is doing to these ranges. So let's mark out the first range of the day and see how price was reacting off of that. You can see from this 1800 profile, price failed to close below this profile and then found its way closing on the other side. We then had price reacting off of this profile, trading higher, price all the way coming back to that drawn liquidity, which is going to be the 1800, finding a rebound off of a previous MCR below this 1800. And then continued higher. So these ranges are going to help us identify where price can reverse or find resistance. So let's look at an internal range right here. We can see clearly that same range being used as an area of interest for price to continue higher off of internal liquidity of this 1800 profile. If we look at that same range, but down to a 1-minute scale, we can see that London MCR, where price wicked into on the 1 minute. We then had price giving us a delivery to the other side of our MCR, where price confirmed back into the range and then gave us a long entry. Before we can start trading the MCR model, I need us to understand a few confluences. The first confluence that we can use in our trading is going to be called the MCR Edge. This is going to be the wick that is left behind at the top and the bottom of our 22-minute MCR range. So a very simple way that I want us to look at this is imagine that this 22 minutes was our candle body. And then this wicks that we're drawing out on the 1 minute for our MCR edge are becoming the wick of this candle of this 22-minute range. So all we're doing right now is turning this 22-minute range into a single candle that we can use support and resistance from its wicks from to get price to react off of it. The next confluence is called an MCR Fortification. It is precisely what it sounds like. Imagine a wick fortifying the low and the high of your MCR range. That just means it is the wick that is supporting price. So if we have a simple way to try and identify where our fortification is, let's take the start of this MCR range and just draw a line back. Take the low of this MCR range and just draw a line back until we get to price that we can overlap with. Okay. What is the wick that is supporting the top of this New York AM MCR? Going to be this wick at the top. Let's draw back on this bottom. which one is going to be the fortification wick for this low of this MCR? Where is price reacting off of? See, price stopped here. We need to find out why price stopped here, and that is the fortification. So if we draw a line to the left, we can see that we have a few things to look at. We have an accumulation of dojis. We have more dojis. We have a larger doji, and we have this big wick to the left. These are all confluences that we can add as our fortification. So let's just be simple. Let's add this larger doji. We can see it overlapping most of these. It's also the low of that MCR. So I'm going to use that as my bottom fortification. The reason why we have this fortification is because we need to identify what is a true breakout or a false breakout. And the only way that we can kind of identify that on a very simple way with wicks is the fortification. Was this a clear break of the low of the MCR? Yes, it was. But was it a clear break past the fortification that was keeping price up in the first place? That's a false. We broke above the MCR. Did we go above? Clean break above the MCR? Did we have a clean break above the fortification? When did we do that? We had a open at this candle, but this was the first candle that officially closed above the fortification. We can see price reacting off that fortification to continue higher. The next confluence I need us to look at is going to be our standard deviation. A very simple way for me to try and explain to you guys what our standard deviation is. Imagine this is the 0.5, which it is, meaning that it is half the size of that current range. So if we extended this out until one standard deviation, which is this black line just right here, we can see that it is the entire MCR range. So all we're doing is just taking the average size of this range and then multiplying it to different levels to try and identify where we're going to catch our reversals. So the first stat that I want us to look at and understand is that 70% of days are going to be false days. So what's a false day? A true day is when we only have one closure on an edge of a MCR, meaning that we only closed on one side and then price continued on that side, but never continued on the other side. A false day is when we close on a low or a high, but price then travels to the other side and has another close. So it's just meaning that price closes on one side, price closes on both sides. So what we figured out is that 70% of days are the opposite. It's the false day, which means that if everyone's going to try and trade that first breakout, bye-bye, money gone. Reason why is because of these standard deviations. We're trying to find points where price are going to reverse from. So let's look at this next stat. We only find reversals up until 1.5, especially on that first breakout. So what we're going to do is we're going to mark out the side that price broke out the first time. So we broke out to that low. We're going to draw a box from our 0.5 standard deviation up until our 1.5 standard deviation. So everything up until this green line, if we don't close upon that, and we start seeing price driving to the other side, we can mentally prepare ourselves for price to reverse. So what do we see when price touches this 0.5 standard deviation? We have price instantly driving back up, closing above this candle. I'll teach you guys an entry model later today, which has to do with candle counting. So this would have been an entry model, an easy buy, taking it to the opposite, 1.5 or 0.5, traveling past the 1.5. And we can see once we travel past this 1.5, we have price continuing higher. And the same way that we identified fortification from our MCR Edge, we can identify fortification at standard deviation. So we came up to 2 standard deviation right here, but created a massive wick at that standard deviation. This is now becoming fortification for that entire standard deviation for price to continue higher. The next confluence I need us to look at is also a form of standard deviation, but this is going to be specifically on our 1800 MCR. So just the hour MCR, not the entire profile. I'll be going through profiles just now. But we're going to use this MCR to get our reversals in our day. So let's mark out our 2 reversal points. So 1.5 and then up until 1.5. So just having this in our chart, we already have 2 points of entries for the day marked out already for us. We already know we're probably going to sell from this point, and we already know we're probably going to buy from this point unless we close above and confirm to continue higher. Once price hits this 1.5, we have our candle count to go lower and then continue to the draw on liquidity, which is going to be our 1800 profile. I want us to keep in mind this 1800 profile of this day is going to be our draw on liquidity pretty much every single day. So if we're above this MCR of 1800, the profile, we're pretty much going to be trading towards it. If we open up on this 1800, we're probably going to be trading away from it. So let's look at another day's 1800 standard deviation, see if we can find something. We can see price coming up to our area of interest after we did our first breakout. So that's going to be the reversal point. Let's do the same thing at the bottom. This is the second reversal point if we do go lower. So let's see what price actually did. What did price do? We saw price creating this massive wick at the top of this 2 standard deviation. We can see in this previous example, I had a 2 standard deviation wick, I believe here. Like you could use this one and you'll see price reacting off of that. But we're going to use our fortification being created on our standard deviation. And we can see price turning this reversal area combined with this wick on the 2 standard deviation, turning it into a floor for price to continue higher. So we're just adding confluence. Let's get another day so we can just see how it works. That's the 1800 MCR. It's a 1 hour MCR. And we can see the same thing happening over and over again. We have our first reversal point on that first breakout. And then we're going to have our second reversal point at this bottom. And here we can see price reacting off of those reversal points to continue price to our draw on liquidity, which is going to be this 1800 profile. And we can see every time we create these wicks at our standard deviation, they're acting as fortification for price to drive to our 1800. We can see price reacting off of these reversal points. Our next form of confluence is going to be our profiles. So our profiles in our indicator, if we go into the settings, we could turn it on right here, MCR daily profiles. We could change the colors in the settings as well. Everything is customizable. The timing is customizable. So I need you guys to go through it yourself and change it like you want it. But getting into this, the profiles itself are going to color in the gap between every single MCR. So we can see the entire profile created by this MCR, meaning it's going to show what price did after this MCR created. We're going to stay on this 15-minute and that same concept that I showed you guys earlier, where we had a wick being left over at the top and the bottom of every single one of these profiles, or well, our MCR in of itself. We can turn these boxes into candles. So this entire profile turns into one candle. And if that's the case, then this is going to be the profile edge that we are going to be using. So let's turn this red. After we do that, we can clearly see how price is using the wicks at this 1800 to drive price higher. So once we confirm above this 1800 profile, we come back in, reacting off of this internal MCR range, and then we go higher. Every single profile we then go further on is going to create a brand new edge at the top and the bottom for price to continue on that next profile. So this is going to be acting like sort of a fortification or an MCR edge, but just see it as a profile edge. So a higher time frame key point of entry for price to react or confirm on. So here we see price closing above, but then reacting back from that original previous profile edge where we continued higher on. And then if we continue that, draw out that next profile, we can see price failing to close below that previous profile and then traveling to the other side of that profile. So if we're going to stay internal, it's consolidation, the same way that we see internal of this 1800 as consolidation, until we travel to any outside or reacting from an edge of this profile, you technically do not have a trade. So you're only going to be trading until price gets to an edge or reacts from an edge or continues from an edge. So let's go to that next day. It's a bit of a smaller day, which is okay. Let's draw out this low of that 1800 profile, and then we have this high of this 1800 profile. And we can see price closing above that 1800 profile in London. Once we do, we create a very tiny edge. We still haven't closed below, so we'll react still from that edge of London. And then price confirms above that edge of London by creating a brand new edge. And you can see how price travels from edge to edge of every single profile and open edges that are left open. So we see these edges are left open, and that's where price is driving towards once we fail to continue higher off of a previous edge. And we can see in the next day, we actually have a day. We call this daisy chaining, specifically on the profile side. So every single time when we have profiles confirming to go higher, we can see that as a confirmation to continue higher on that next profile. So saying that this profile closed above this previous profile and had a continuation, we can kind of see that next profile to do the same. Closed above. You can kind of see the next profile to be a bullish profile as well. See here we have the profile edge again, but we failed to close above that profile edge, but price still continued higher in that profile. That next profile edge. And then we create a new profile edge on this profile that failed to close below. And what do? If price opens on a profile edge, we can kind of see that as an area of reversal for price to drive and continue higher. We're here, price confirms above this profile, and then we use that same profile edge to continue higher. This next confluence is going to be called our daily and our weekly nano range. So a nano range is pretty much exactly what you think it is. It is just a very tiny range of the MCR. So if the MCR is 22 minutes, expect the nano range to be around 6 minutes. And if we go to our indicator and we turn on the Monday DCR and we turn on nano ranges, what are we going to get? Right now, we're looking at the Monday weekly DCR, and then we have our daily nano range. The first one I'm going to go through is going to be our weekly DCR. This is a range created from 6 o'clock, I believe, until 11 o'clock at night on a Monday. And this in of itself is going to be acting as our drawn liquidity and our fortification over support and resistance for the entire week. So we can try and use that same logic, which is true day, false day. We had a true day on DCR closing below. We had a reaction inside of DCR continuing price. We had DCR being our drawn liquidity. We had price reacting off of that DCR, drawn liquidity again, and then acting as resistance. This happens pretty much every single week where that DCR for that week is acting as drawn liquidity or a reason for price to react and draw towards. Now we're going to be looking at our daily nano range. This is just a 6-minute range, and that's exactly what you think. It's just a very tiny MCR. And we can see sometimes we can use that as an entire 15-minute candle. So we are going to use this as drawn liquidity and also a support and resistance for the day. So we can see price never came back to that daily nano range, but we did use it as drawn liquidity every single time we reacted off of these profile edges. And then we can see right here, we have a new daily nano range where price reacted off of it multiple times for an entry and using it as drawn liquidity. Here we have the next, but see, this one's not an entire 15-minute candle, but it's still going to show you the entire nano range. Here we can see price confirming on that nano range and then trading away from it. That next day, nano range, if we draw it out, We could see it being used as drawn liquidity and then price reversing every single time we touch that nano range. Let's move on to that next day's nano range. We can see price confirming above this nano range and then reacting off of that nano range to continue higher and it acting as drawn liquidity. We're pretty much just going to use this entire 1800 profile as a drawn liquidity instead of just this nano range, expecting price to always touch this nano range. So just always use that entire profile as your drawn liquidity. The next confluence I want us to look at is going to be our money flow and wave indicator. So this is just going to be some sort of like a pivot indicator, but specifically on the momentum side. So it's going to help you get in a directional trade to make sure that you're not going to get stopped out real quick. So what do we see from this? We're specifically only going to use this once we get to our area of interest, but I'm going to use that in a different video. But I'm going to go through how we can trade this specifically just looking at this indicator. So what do we see? We need to match up these sell signals with our money flow being oversold or overbought. Okay, cool. So what do we see from that? Every single time we have our crossover, so we see this lighter line crossing over with the dark line, we get our sell signal. But specifically only when we're overbought or oversold. And we can see that the money flows in the red. That is going to be a really good signal on the higher time frame if you're going to be scalping on the lower time frame. So look at this. We get our sell signal at this candle and we at least get 20 to 30 tick travel to the other side of this 1800. We get our sell signal with money flow in the red on that 15-minute. And we at least get a 20 to 30 tick travel. Let's look for our next combination. So here we see price at this candle giving us a money flow in the green, slightly, but it's there. And then it's giving us the buy signal. We at least get 20 to 30 tick travel. So if you're going to be scalping this on the 1 minute, really, really great. Let's look for another combination. Here we see money flow in the red, so we're only looking for sells. Here we see we are oversold. And here we see we have a sell signal. From this point, look at price traveling. We have money flow in the green. We're oversold. We get our buy signal. And look how far price traveled. The last confluence I want us to look at is also going to be the only paid thing in this video. It is called the Markov indicator, and it is a pivot indicator, same way as the momentum indicator, but this one gives you a stop loss, it gives you a take profit, and you can set those stop loss and take profit levels in the indicator yourself, and it will give you signals and alerts. So let's add this to our charts. So we added the Markov indicator to our chart now. How do we trade this Markov indicator in combination with our wave indicator to get better signals? So we've already explained it how we're going to trade this wave indicator. Now we're just going to match this signal with our Markov indicator to get a better entry. So once we get our signal for a sell, we get our previous high signal from the Markov indicator giving us a stop loss of 18 ticks. And then we can travel as far as you want, specifically to that 1800 profile. Here we get a crossover for a sell, we get our stop loss, and then we trade to the 1800 profile. Okay, so let's look at this next signal. This next one got taken out. Why? Because we never had our crossover. And specifically at this point, we were barely oversold. Here we get our signal again. And I believe 1 or 2 candles later, we then had our indication for a buy. So that's just extra confluence if you wanted to take that for 30, 40 ticks up until that 1800 profile. Remember, we're only trading until 1800 profile as our drawn liquidity. And then we can see once we get our next signal for a sell, it matches up with our previous high. There's our stop loss, and we can travel all the way to that low. The same way we can trade right here. We have our stop loss being taken out on that previous low. We did get a re-entry on that trade with a new stop loss traveling all the way to the DCR or 1800 of that day, where we get another sell signal confirmation on that wave indicator where we had our sell at least for 100 to 200 ticks. If you guys want to buy this indicator, I will leave my Discord name in the description and the comment section down below so you guys can chat with me directly if you guys want to get this for yourself. We have just worked through every single confluence I want us to look at. Now we need to identify what to do once we have gotten to that area of interest or that confluence that we want price to reverse off of. So let's just get a standard one, which is going to be our standard deviation. We see price reacting off of that standard deviation, specifically in our area of reversal up until 1.5. We see price reversing. What is the first indication that is going to tell us that we get a reversal? Not a fair value gap. It's not an order block. It's not a breaker block or a unicorn. It's the most simplest way that I can try and explain to you guys that we get a confirmation is candle counting. Candle counting in of itself is just telling us that we have price closing in another direction that the trend was currently going, but specifically closing above the candle of that trend. So we see price going bearish, but hitting our area of interest. The first counter move was from this candle that closed on the other side. So this is going to be our area to go in for a long. And we see the indicator itself, the MCR indicator itself, drawing out that candle count, that green candle. It's telling us to buy. Earlier, I explained the fortification at our standard deviation edges. We can see that once we got to our standard deviation of 2, we created this fortification edge with this wick. And if we use the same logic of looking for an entry once we have a confirmation above a candle going in the opposite direction, what do we see? We see price ranging back towards the standard deviation fortification edge of 2, and we get our candle count within 3 candles. So we're only looking for candle counts specifically within 3 candles. What do we get? We get the indicator giving us a green candle, telling us we have a bullish candle count reacting off of this previous candle. It's literally giving it to you. You don't have to think about it. Where did price go? Where did we react? We reacted off of the wick from that original candle. And this original candle we call 0 candle, because if we count 0, 1, 2, 3, you understand? So we have 3 candles after this original 0 candle to close on another direction. So within 1 candle, we closed on the other side. Same way here. We touched our area of interest. This is now becoming our 0 candle. This is the wick supporting that 0 candle. How many candles did it take for us to close on the other side? 1, 2, 3, 4. So 1 candle extra, but we do see that we do have our candle count being confirmed right here. And the reason why the indicator sometimes draws out the candle count on a green candle or a yellow candle or a red candle is because we see the indicator highlighting that price was actually not going past this candle's edge, and until we closed above that candle, the trend was bearish. So we're going to look for sells if we do not close above that edge, but we did. So price then went bullish, and look at what candle we reacted off of. It was that original 0 candle where price failed to go lower on. This is what I'm going to be classifying as my A+ setup when we're going to be looking for candle counting. So we have our price reacting from one of our confluences, and we get our candle count. The issue is you're not too sure if this candle count is going to hold. And a very, very good way that you can add a layer of support for that candle count is by looking if it overlapped a doji. These dojis are going to be appearing at pivots, so you can mark them out pretty much every time they come through, because they don't come through every single time. It's very seldom. But look at what happens is we get our candle count, and where does price react off of? It reacts off of that support from the candle count being supported by that original doji. So let's apply that same logic to when price came back to our fortification on that standard deviation of 2 on that original New York AM MCR. We never continued with price until price had a candle count, which was step number 1. But step number 2 was it only went bullish and continued in its bullish drive once price had a candle count above a doji. So that was the original candle count, right? We had price closing above this original candle where price failed to close below. What was the reason for price to not continue? Had our candle count confirming above a doji. where that Doji becomes the support for your stop loss. And this is why we can go 18 ticks with our stop loss, is because if we govern at least this Doji, we govern that 18 ticks. Thank you guys so much for watching this video. Hopefully by watching this video and understanding the candle theory model, you guys can get profitable trading. If you guys want to buy the Markov indicator, I will leave my Discord down below and you guys can contact me there. Thank you guys so much for watching, and I'll see you guys very, very soon.